So let's get back to the marketplace. In a relatively busy week on the Nigerian debt market ends today, with investors digesting a bit of macro headlines, but more on the financial regulatory side regarding the exchange rate market and treasury activities. Victor ALUYI is head of portfolio management at COMERCIO Partners Asset Management, and he joins me now to review the Nigeria fixed income week ahead of next week's MPC decisions. A good evening to you, sir. It's good to have you on the show.
Good evening, boss, and thank you for having me.
Thank you, Victor. Let's just talk about the summary of this week's fixed income or trading week on the primary market side and on the secondary market side.
All right. The week has essentially been characterized by, buoyant liquidity like we've seen for the better part of the month. System liquidity started with about 300 billion. We had inflows of about 350 billion from own maturity repayments. We had about 141 billion from coupon payments. So funding rates closed significantly lower than where they started the week. If you look at the treasury bills market, activity started out quite quietly and with very little volumes traded at the beginning of the week as market participants essentially anticipated the primary market auction midweek. That auction came in relatively strong with a bid to cover ratio of about 1.8 times and the stop rates printing at 1.09, 1.5 and 3.05 for the 91, the 182 and the 364-day papers respectively. However, if you look at yields across the treasury bill curve for this week, we saw a decline of about 50 points to an average of about 1.5%. Month to date, across the treasury bill curve, yields have declined by about 55 basis points. If you look at the bond markets, started out the week relatively bullish, again, because of the coupon payments inflow that essentially spurred a bullish bias at the beginning of the week. However, that bullish bias was softened midweek, particularly with the release of the inflation number, as market participants essentially digested that number and continue to grapple with their returns deeper into negative territory. But in all, yields across the bond curve declined by about 12 basis points on the average to about 7.55%. We saw the steepest decline at the midpoint of the curve, about 21% down week on week. Short end of the curve about 4 basis points down, while the long end of the curve declined by about 7 basis points week on week. If you look at across the bond curve, week on week, we saw that 12 basis points decline. Month to date, yields have declined by about 54 basis points across the bond curve. The strongest decline again at that midpoint of the curve, 43 basis points, while we saw about 12 basis points decline at the short end of the curve month to date. So clearly, the liquidity in the system that continues to come through, the paucity of instruments within that space essentially continue to force yields lower.
Is there anything new on Market Street, by the way? Are there any macroeconomic headlines this week that is feeding into the market space?
Well, like I highlighted, that inflation number was one of the things that, affected investor sentiments in the course of the week. Like I said, that number came in at 13.22%, the 12th consecutive month of increases, and its highest points in over 24 months. So clearly investors continue to grapple with, this negative real return that even gets steeper. These are the issues that, unfortunately, investors have to deal with. There's a huge paucity of instruments within the market, and it was even, shrunk even significantly more with the OMO ban policy that the CBN put in effect about a year ago. If you then juxtapose that with the amount of liquidity that continues to come through, the yields essentially kind of have just one direction, at least about the near to medium term.
So when you look at developments within the monetary authority side, are there anything significantly feeding into investors' sentiments for both local and foreign players?
I think probably the most pertinent or front-burning issue right now is around our external position, particularly with respect to the foreign exchange situation. That's something that investors both locally and foreign investors also continue to monitor quite closely. This week alone, we saw turnover at the I&E window of about $766 million. The CBN commenced sales to BDCs last week. That we expected to essentially assuage, the decline that we had seen. We saw that knee-jerk reaction, but that those rates have kind of trended back up. So I think the FX situation is really, really significant, and that's one thing that both local and international participants continue to keep an eye on.
What's your take on next week's MPC?
I don't expect any major decision there. Really, over the last couple of MPCs, we've essentially looked to some sort of guidance in terms of what the Apex Bank is looking to do, particularly with the FX situation. We've seen quite a number of moves by the Apex Bank to try and, bring that situation under control with both conventional and, if you will, unconventional moves. And the results aren't so strong yet. So clearly, we'll probably be looking for some further guidance or direction in that area. But in terms of the, benchmark policy and all those other rates, I believe that the committee is likely to maintain status quo.
We need more investment inflow on a sustainable basis. So how do we get it, Victor?
The FX issue really is a major challenge, and that's what investors continue to look at. There is great need for liquidity in that space. If you're bringing money to invest in a country, you want to be sure that whether it's by your profits or whether you want to take capital back out, that there aren't any restrictions. So once you have these sort of restrictions or challenges, it weighs on the minds of investors. So it's not a simple situation for us to deal with. We were here in 2015, 16, and here we are again. I believe that the Apex Bank will continue to work hard to, assuage the concerns of investors to ensure that we see those flows. If you look at the capital importation report so far this year, it's been very poor compared to last year for obvious reasons, the COVID-19 and all of that. But again, the FX situation remains a key part of that, and that needs to be addressed for us to see any meaningful flow of investment into the country.
Structural issues, like you said, that we can't just fix overnight the way things look right now, unless we just get some major inflows from somewhere, perhaps the World Bank next month. Thank you so much, Victor ALUYI of COMERCIO Partners Asset Management. Have a great weekend.